It is Friday, the 15th of January. Boy, am I glad I don't work in the stock market. My whole working life has been near the bond market, whether it's mortgages or real estate or fixed income. And we, of course, are the beneficiary of what's taking place in the stock market. Sort of. When stocks run into a really bad patch, there's a certain amount of money that moves over to the bond market for safety. But there's something else going on here. The stock market movement downward in the last weeks is a symptom. It is not a cause. The whole world is watching China. Everybody's probably very nearly sick of the subject by now, but that's what's making things move. And this week's worth of bad stock market, not just here, but all over the world. I mean all over the world. And that's a signal that there's doubt about the global economy itself. The source over the weekend, first thing Monday morning, was another exceedingly clumsy effort by China to begin to reduce the value of the yuan, which theoretically would boost its exports. Its exports are already immense and are troublesome to the whole rest of the world. A lot of the rest of the world tries to export things too, and the Chinese effort is this bizarre balancing of trying to create export revenue to cover for yuan leaving China, and leaving China by the $100 billion a month. People trying to get money out of the place. I haven't been to China. I don't speak Mandarin, but this is just money. And there are people trying to leave China, trying to get their money out of China because of the really aggressive mismanagement of the Chinese economy. For 20 years, China expanded at a very rapid pace based on a very simple formula that government would spend whatever money was necessary to create new housing, to create new factories, to create the infrastructure that people here in the United States would like to do. But China's finally run out the chain. It doesn't have the capacity to continue to invest on that scale, and the investments themselves are unproductive. And China's now trying to rebalance its economy to a modern economy, to open markets and a consumer economy, not an investment economy. And everything China has tried now for almost 2 years has backfired and left it in worse shape than it was before. Back to the States. We've been in this extraordinary disconnect in which the Federal Reserve is the only central bank in the world tightening policy, raising interest rates. The rest of the world is all trying to ease at the same time. Never seen a disconnect like that before. And the market shocks this week are an indication that it isn't working very well. It will be embarrassing for the Fed to announce that it has to slow down, that it's not going to tighten after all, that it may go on indefinite hold, but that's what's going to happen. The Fed may try to tighten again, it may try to hold on to its story for a while, but the longer it tries to hold on to a bad story, the worse it's going to look. In the meantime, we're the beneficiary. Mortgage rates back to 3.875, little or no in the way of fees. Mortgage rates are down 0.25% since New Year's Day. Everybody knew they were going to go up, and they've come down. So on that happy note, forget about the stock market. Have a good weekend.